From the Nasdaq market site in Times Square, I'm Jill Malindrino for the Voice of America. And as we can see here, just about 1% enjoyed by all three major averages because of that great jobs number we had this morning. Crude oil was also trading higher as it trimmed its largest weekly decline in 5 months. Meanwhile, gold is set for its first two-day drop since the Brexit referendum. 287,000 jobs were created in June, which was way above consensus and one of the strongest beats in a year, following a bullish ADP employment report on Thursday. The unemployment rate was at 4.9%. The unofficial start of earnings season is on July 11th when Alcoa reports after the bell. According to S&P Global Market Intelligence, only 4 of 10 S&P 500 sectors are projected to have positive earnings growth, including consumer discretionary, industrials, utilities, and healthcare. The energy sector is once again expected to post the largest decline in growth, though the decline is an improvement from first quarter results. Other sectors with large declines in growth are financials, materials, and information technology. Excluding the energy sector drag, S&P 500 earnings growth would still decline 0.7% in Q2. Joining me with more on the jobs report and earnings outlook is Chris Dearborn, Managing Director from the Markets Intelligence Desk at the Nasdaq. Chris, that was a great number we saw this morning. What are your thoughts on that?
Well, Jill, thank you so much for having me here today. And the print today of 287,000 was much higher than expected. We polled economists looking for anywhere from 170 to 180,000 jobs in the creation level, which was much, much higher than what we saw for the previous print in May, which was 38,000. But that was also revised down by 11,000, which was, again, significantly divesting from one to the other. So what you're looking at is maybe an anomaly for May. Even if you take out the Verizon strikers that kind of affected that, you're looking at a much higher print. You're looking at good job creation here, and it kind of goes with a lot of the numbers that we've seen across the board. A couple of things in that print that we look at that kind of give you an idea of what's going on. So you're looking at wages. Now, wage growth came in at 0.1% less than growing over year. So it came at 2.6 versus 2.7%. Again, it's something I think the Fed's going to be looking at when they go to the next meeting. So you have the next meeting coming up here in July. And people are expectations for 2016. If you look back in June 1st, before all this data started coming out, you snapshot in time, and you kind of want to see what they were thinking, especially on the back of the Fed minutes being released only a few days ago. You kind of want to look at what they're doing. The reason why this is important is because rate hike is something that's on everybody's mind. And at 0.25%, where we are right now, and that came back in December, people think that they kind of missed the boat because that was delayed at that time also because of Chinese data. And we're looking at a raise last year of maybe September, October. So they finally raised it before the end of the year. And then beginning of the year, they said we're looking at 2, maybe even 3 rate hikes this year, right? We're expecting strong economic data. It's going to be great for the economy. The U.S. is going to move along very, very well. Well, each time you've had a snafu in economic data, they've taken a step back, and that has kind of tempered the moment. And June 1st, a poll by a number of different economists had a rate hike for the end of 2016 over 65%. They're going to do it.
Right.
You know what it is now? 2% for the next quarter, maybe 12% by the end of the year.
Right. I mean, isn't Fed Fund futures are pricing now to almost February 2018? But since we had the poor jobs report the first week in June, then we had the Brexit vote. Since then, data's been pretty good. ISM was a great number. ADP employment numbers were great. Today blew away consensus. Do you think they might have to revisit a potential rate hike?
I think they do. I think what you have here has been a lot of flip-flopping from the board, from the Fed board that is, on different economic points and kind of looking at the minutia of each specific item. What you really have is a growing U.S. economy. You've had fantastic retail sales as well, coming in very strong. And again, remember, the U.S. consumer buys 2/3 of the economic output for this country.
Right.
So you're going to be pulled up by the seat of your pants by spending. And if you have job creation, you have people with cash in their pockets, they're going to go out and spend. Whether they're spending on restaurants, whether they're spending on cars, whether they're spending on technology, they're out there getting that economic output going. And that's significant for getting this country back on its feet. And again, the United States is one of the economic leaders of the world. And if there's going to be a rate hike, it's not going to be coming from Europe. They have their own issues right now. It's not going to be coming from any of the other. It's going to be here in the U.S. to start the next round. And I think that 2016, they're going to be talking about it. You've got a number of Fed governors speaking next week, and there's going to be a lot of flip-flopping, I think, between the hawks
But
and
we
the
saw that
Doves.
in June as well, and the volatility that it created in the market there.
Absolutely. There's only one Fed governor that may be speaking. He speaks on Friday, and he's going to probably be saying, the banks are too big to fail. He's the only one who hasn't changed his mind. But other than that, I think you'll see a little bit of flip-flopping. What's more important is to see what the minutes are after the July. I don't think anything's going to happen here in July. It's a 4% chance of that. I'm not a betting man on that, Adam. But what you will see is what they're looking at. I want to know what they're looking at. What are they talking about? What do they think is important? What do they think has changed?
Right.
And more importantly, then towards the end of the year, maybe with a presidential election coming up, they might hold themselves back a little bit. But you never know. We might see potentially, depending on how things play over the next 5 months, a rate hike in December again. And then remember, if they feel that the economy is starting to fall back a little bit, they still have the ability to cut as well.
Right. Well, it's really interesting that you bring that up, and we saw that the market reaction following the rate cut in December. We had a lot of volatility in January, a lot of volatility in February, but flash forward to around April, May, we came back to even on the year. And look at, this is very interesting when we see in the indices right now. We had the S&P up over 1% at a very, very key level because we are almost mirror image to where we were last year.
It's uncanny how last year, early July, I think it might have been the 15th, you're trading at almost the same level as where we were last year. Now you take out the Brexit vote, you take out all of these other uncanny economic items that have just been weathered by the U.S. consumer, and much less institutional traders, retail traders, and everybody else who has their hands in the market. You're trading at all-time highs here. You're over 18,000 on the Dow. We're almost at 5,000 again on the Nasdaq Composite, which is a broader index of all companies listed here on Nasdaq that gives you a good breadth of how the overall economic situation is going here in the U.S. So you've got multiple indexes all trading at highs. You've got good consumer data. You've got non-farm payroll creation, jobs being created here in the U.S. You've also, what we haven't mentioned, was that you had initial jobless claims last week. Initial jobless claims for the last 70 weeks have been under 300,000. Now that's a strong sign of growth, and we haven't seen that since the early 70s back in this country. So what you're seeing is people are working, people want to work. People are looking, they're not making as much as they were year over year. However, they are more people in the workforce. So what that means is that you have more people as a whole out there with the ability to spend. Again, 2/3 of this economy is powered by spenders, shopping.
Right. So I think the big thing over the summer is to see if we can break through all-time highs. And I think it's interesting that we have earnings coming up next week. I want to get your thoughts on that. But we've been in an earnings vacuum, and this happens every single quarter where we have nothing on the board in terms of stuff to analyze what companies reporting, and all we talk about are these macro issues. I think everyone's exhausted from talking about Brexit and what the Fed is going to do. So if we get good numbers out of earnings reports and expectations are really low following not that great of a first quarter, they can blow away those numbers. It could be possible that we start to see higher levels on the S&P and the rest of the indices.
Absolutely. What you're looking at next week with Alcoa kicking off the earnings season is an expectation for a lot of one-off items that can be very newsy and drive higher volumes. Remember, there's an old adage, especially from the traders, that you sell in May and you go away. Well, that hasn't happened this year because you've had way too much to concentrate on. And especially looking at earnings coming up could be a very good catalyst for one-off items, which could drive the markets higher, especially in a non-news type of way. You have some economic data coming out over the next couple of weeks, which will be good for the overall markets, but single stocks, if they do well, will drag the economy up. One thing about that is that you've got lower volumes expected for July and August, generally speaking. However, on the back of the Brexit vote and on the back of the Russell rebalancing a couple of weeks ago, and on top of all the other economic items, we've had higher volumes in the month of June than we've seen in almost 5 years. The Brexit vote, we saw over 15 billion shares trade here in the U.S. You haven't seen anywhere close to that until 2011, what they call Black Monday, when the U.S. sovereign debt was downgraded from AAA to AA+. So you're talking about record volumes. People are investing in the market. They're trading. They're looking for items, and the market keeps going up. Economic data is good. The Fed will talk about what they're going to do. One-off stock items such as earnings will help be a catalyst for this, and the volumes will continue to grow as good economic data, markets trade at all-time highs. And one other item I'd like to mention is, we call the fear index, is the VIX. Now, the VIX is an item that measures negativity in trading, and it generally trades, the higher the number, the more fear there is in the marketplace, and the lower the number, the less fear in the marketplace. And by fear, we're looking at what an option world puts. And what they're looking at is how they can place the stock at a certain price. And with the VIX item, the higher the volume, the more puts are being bought. So where you have right now, VIX trading about 13, which is half of what it was 2 days ago. So what you're looking at is people aren't afraid to buy. And you're seeing investors come to the market, as you are right here with all-time highs and good volume. People are weathering these interesting, I would say even fearful economic points and taking them and using them as a buying opportunity to get involved in the market. Look at the Brexit vote. The market was down over 4% at the end of that day. It was down almost 7% in the morning before we even got started. And now we're trading at almost all-time highs.
Right, but I mean, it makes sense though into the U.S. markets, because if you have uncertainty in emerging markets, if you have uncertainty in Europe and what's going on in the UK, where else are you going to put your money? You're certainly not getting it in bonds, which is why we're seeing great moves in utilities, telecom, good established companies that have high yields, a great track record of paying dividends. So it almost makes sense that you're seeing money come into the stock market because you're not yielding anywhere else.
You're chasing growth, and you're chasing price. And as you chase growth and price, people are putting money to work. And when you put money to work, you're going to see higher highs. People want to buy companies. They don't want to sell. They'll take their profits, let's say, go. But other people are in it for the longer term, and they've had their cash on the sidelines for such a long time because you've had so many fearful items. They don't want to be part of that risk. They'd rather see the risk play out and they get involved later on. And I think that's what you're seeing here with these indices as they're rolling higher. And I think that the economic data that's coming out is supporting this move.
Okay. All right. Thank you very much, Chris.
Thank you,
Appreciate
Jill.
that. From the Nasdaq market site in Times Square, I'm Jill Malindrino for the Voice of America.